Net present value, commonly known as NPV, is one of the most important concepts in corporate finance. It helps investors and businesses determine whether a potential investment is worth pursuing. At its core, NPV answers a simple question: what is the current worth of money that you will receive or pay in the future? Throughout this video, you'll learn how NPV works and why it's essential for making smart financial decisions. So what exactly is NPV? First, it's a financial metric that measures investment profitability. Think of it as a tool that tells you whether an investment will make or lose money. Second, NPV converts future cash flows into today's dollars. This is crucial because money tomorrow is not worth the same as money today. Finally, NPV helps determine if an investment is worthwhile by giving you a clear number to base your decision on. Before diving deeper into NPV, you need to understand a fundamental principle: the time value of money. This principle states that $1 today is worth more than $1 tomorrow. Why? Because money today can be invested and earn returns. It can grow over time. NPV accounts for this fundamental principle by adjusting future cash flows to reflect their value in today's terms. Now let's look at the NPV formula. NPV equals the sum of cash flow at time t divided by 1 plus r raised to the power of t, minus the initial investment. Here, CF represents the cash flow in each period, r is the discount rate, and t is the time period. This formula discounts each future cash flow back to its present value, then subtracts what you initially invested. The NPV calculation has 4 key components. Cash flows represent the expected money received or paid in each period. The discount rate, often called R, is your required rate of return or cost of capital. The time period, represented by T, indicates when each cash flow occurs in the future. Finally, the initial investment is the upfront cost needed to start the project. Understanding each component is essential for accurate NPV calculations. Let's work through a simple example. Imagine an investment requiring an initial investment of $10,000. In year 1, it generates $3,000. In year 2, it generates $4,000. In year 3, it generates $5,000. Your required discount rate is 10%. Now let's calculate the NPV using these numbers. Here's how to calculate NPV step by step. The present value of year 1 is $3,000 divided by 1.10, which equals $2,727. Year 2 is $4,000 divided by 1.10 squared, equaling $3,306. Year 3 is $5,000 divided by 1.10 cubed, equaling $3,757. Adding these together gives a total present value of $9,790. Subtracting the initial investment of $10,000 gives an NPV of negative $210. Finally, let's discuss how to use NPV for decision-making. The rules are straightforward. If NPV is greater than 0, accept the investment because it creates value and generates returns above your required rate. If NPV is less than 0, reject the investment because it destroys value and fails to meet your required return threshold. In our example, the NPV was negative $210, so you should reject this investment.
If you like this video, hit that like button and don't forget to subscribe. Visit codelucky.com for more such useful content.